Howdy, folks. We're in Alaska. Let's get started. For the last 3 years, BDCs, or business development companies, have been one of the undisputed kings in the dividend world. While the S&P 500 may have returned 1.5%, business development companies, or BDCs, return anywhere from 10, 12, 13, 14%. Large gap between those two. But things are changing, and those high interest rates that fueled the markets are beginning to turn. So if you're just looking at yield or top 10 lists of what BDCs are paying the best, you may be flying a little bit blind as to what the marketplace has changed and how things are going to be affected going forward. Today, we're not going to do just a surface level review. We're going to look at the dark corners of the BDC market, the balance sheets, and the stuff that most YouTubers or people don't report on. We're going to look at things such as PIK, payment in kind. We're going to take a look at how AI is affecting the marketplace, what that means for BDCs, and get a little bit better overview of what's all going on in the market and dig into a couple of details. So stay with us. By the end of this video, you're going to have a much better idea of which BDCs are fortress plays and which ones you want to kind of maybe pay attention to as you begin to do your research on what you think might work best for you. Now, full disclosure, I'm not an investment advisor. We're just doing research and learning about BDCs and the marketplace. For those things, if you're going to make investment decisions, I'd highly advise that you talk to a licensed broker or investment advisor. Let's dive in. To understand the risk, you have to understand the spread. BDCs lend money to mid-sized companies at times where they're using floating interest rates and borrow money at fixed or lower interest rates. The issue is, in 2026, the benchmark rates have begun to moderate because possibly 80 to 90% of BDC loans are floating rate. Their total investment income is dropping immediately. Now, most people will hear interest rates are good for the economy, but for the business development companies, that's not always the case. First, the margin squeeze. Their income drops faster than their interest rate expenses. When interest rates come down, so does the variable rate. Second, the refinancing trap. Many BDCs used lower expensive interest rates back in 2020, 2021, and 2022 to come up with the capital to help to fund their operations. That debt is now maturing in 2026 and 2027, and those rates could potentially be much higher than what they were purchasing, and their lending income is falling. A key metric to watch is net investment income versus dividend coverage. If a BDC was covering its dividends at 120% last year, maybe it might be 105% this year. And that special dividend you've been enjoying is likely the first thing to go. And we have seen some dividend cuts already this year. Here's a key point where many investors get caught, or people that are monitoring BDCs. And let's talk about payment in kind, or the PIK interest income. Imagine you lend a friend $100 and he owes you $10 each month. So this month comes up and he can't pay you that $10. What you can do with payment in kind is add that $10 to the balance of the loan. So in effect, what happens now, that loan balance of $100 just went to $110. Now, this isn't always a bad thing, but sometimes it can be. In 2026, we're seeing a spike in payment in kind payments from the BDC, from the companies that are in the BDC back to the BDC itself. Fitch reports that possibly 50% of institutional investors expect PIK income to rise this year. On the income statement, the PIK interest or PIK dividends look like income, and for accounting purposes, they are. However, the problem is they need to pay their investors the dividend at whatever time interval that they have selected, whether it be with Maine, which pays a monthly dividend, or another company that pays a quarterly dividend. And that's where part of the challenge comes in. In other words, you can't pay investors with tabs on your bill. Now, here's a bit of a red flag. If you see a BDC where PIK income represents 10 to 15% of their total investment income, They may not be growing. They may be evergreening bad loans or loans that aren't producing to help keep their non-accrual numbers looking low. Check the supplemental data in the 10Q and look for cash NII versus total NII, or net investment income. If this gap is widening, the dividend may be in some trouble. Another issue that we have to pay attention to, and this has come up in media reports, the AI risk in BDC portfolios. Nobody was talking about this 2 years ago, but in 2026, it is the number one concern for institutional credit analysts, and that's called software portfolio exposure. For years, some BDCs love software companies. Why? Because you got high margins, recurring revenue, and the customers were very sticky. The people that purchase that software from these companies tend to continue to renew it and hold on to it. That's what we mean by sticky. However, generative AI has turned sticky software into vulnerable software, and this is where you see some of the uncertainty coming in. Companies that used to pay, let's say, $50,000 a year for coding tools or customer service SaaS or software as a service are now using internal AI agents. Sometimes we think of these as called chatbots. Now, the analysis gap that we have to look at is we need to look at industry concentration. If a BDC has a lot of software as a service in their portfolio, they could be high risk. Or is it heavy in infrastructure and mission critical services, which would be lower risk? And so with some firms, we're now taking a look at these BDCs based upon their AI or artificial intelligence vulnerability. If your BDC that you're looking at has 30% plus exposure to business services or generic software, you need to be asking, are these borrowers going to exist in 3 years? So who is actually winning in this environment? It's all about scale and underwriting. Hercules Capital, ARCC, is a well-run and well-known BDC. Their size allows them to dominate the upper middle market. So we're talking about loans that are generally from $100 million to $1 billion, a little bit too big for a smaller local bank and not quite large enough for a large corporate institution. These customers, or the middle market, that's where the BDCs begin to flourish. Main Street Capital, another excellent company. This company is sometimes known as the monthly dividend darling. Why are they safe? Because they're internally managed. So in a low rate interest environment, that 2% savings is the difference between a dividend cut or a dividend hike, or at least potentially. Another well-known company, Blackstone Secured Lending, BXSL. That company has 98% of first lien senior secured debt. So in 2026, you want to be first in line to get paid. Smaller, newer BDCs with less than $1 billion in assets may be struggling some to find some of the premium loans that they want to do business with and the premium small private companies. They may be forced to take on risk that maybe the bigger lender passed on. Not always, something to just consider and to keep in mind. So how do we evaluate these BDCs? Well, here's the 5-point checklist. If you want to outperform some of the companies that aren't doing so well, here's a 5-minute checklist for every quarter. Net asset value trend, NAV. Is the net asset value per share growing or shrinking? So if the price is $20, but the NAV is $15 and falling, you may be looking at some problems with wanting to take a look at that company. Net debt to equity. We want to stay between 1.0 and 1.25. Anything higher than 1.4 in 2026 could be getting into a danger zone in terms of leverage. Another important thing to look at is the lien mix. We want to stay 80% and higher in terms of the ratio between first lien and second lien. So for the first lien, that BDC that lent that money is first in line to be paid if there's any troubles with that company. Another good point to look at is spillover income. This is a BDC's savings account, and a high spillover rate means that they can pay dividends even if they have a bit of a challenging quarter. Another important point, external versus internal management. Internally managed BDCs like Maine generally have lower operating costs. Now, don't get me wrong, BDCs are not dead in 2026. However, we are seeing a more active market. We're seeing some more focus from the media, and people are beginning to pay a little bit more attention. We hear a lot about private equity, for example. And so people are beginning to ask that don't even invest or have any interest in the market or things of those nature, beginning to question, well, what is private credit? What is private banking? Why do they call this stuff shadow banking? Well, it really isn't shadow banking. And so the days of just buying something with a 10% yield because it was a BDC, that's not going to quite fly so much anymore. People are paying more attention. There's a lot of media focus on private banking and private equity. And so there's quite a few people that are beginning to pay attention to this just because they want to learn. So 3 things that people are looking at when they look at investing or at least curious about BDCs. Number 1, the smart money is looking at low PIK income. We're talking about PIK dividends and PIK interest. A low AI vulnerable portfolio and software exposure is another thing to take a look at. And high spillover reserves. If companies are generating cash and they don't pay everything out every quarter, for example, that's where we see our supplemental dividend, and you may see that once a year, for example, but that would be something that you could take a look at and say, well, there's some spillover income. They generated more cash than they pay out in dividends. However, they don't have to pay everything out in any particular quarter unless possibly it's the end of the year. And now we take a look at that spillover income and the supplemental dividend. And that's why you'll see a dividend payout. You're getting the monthly or the quarterly, and it's pretty much a fixed or set rate. And then all of a sudden, the supplemental dividend comes up, and you wonder where it came from. Well, spillover income is one place that it came from. There are other things that contribute to that, but spillover income is one of them. So this is great that we have these opportunities to take a look at this stuff and potentially invest as we go forward. If you're an investor, I encourage you to keep watching the channel. Tune in for more. We're going to be taking a look at additional information. We're going to look at quarterly reports of some of these BDCs, and we've got a system developed where we can analyze this pretty quickly and come up with a decision as to, hey, I like this BDC, or I'm not so happy about this BDC, or hey, this one has done pretty well, and we're going to sit with it, and we're going to work with it, and we're going to be patient. If you like this video, leave a comment, hit the like button, and let me know what you guys think. Love to hear from the viewers. We'll see you soon.